Just before we move to the next session, there is an interesting announcement. So we have two prizes up for grabs. One is an Apple Watch and one is a leather bag. So don't forget to put your business cards. There's a bowl kept in the registration desk. Just drop it there. So if you're lucky, you will go home with one of them. So let's move to the next session, which is on transfer pricing by Mr. Rishi Sapra, who is the Associate Director with MMJS. Welcome on stage, Rishi. Thank you.
Hi, everyone. Good morning. Hope you have been enjoying the sessions which have taken place till now. In the next half an hour, we'll be discussing on the topic of transfer pricing, which is again a very interesting one in view of the UAE corporate tax regime. I'm Rishi Sapra. I'm a transfer pricing associate director at MMJS. And this topic is quite close to my heart as well. I have been practicing this for the last 15 years. And it's still a learning because the law is developing over time. The transfer pricing law is new in the UAE, but it has been quite an matured subject if you talk about countries like UK, Netherlands, and India as well. So yeah, going through the basics first. I'm sure every one of you would have heard about this subject by now. For those who have and for those who haven't, I think it's always good to refresh the basics a bit. So transfer pricing basically relates to pricing of your intercompany transactions, which basically means your transactions with related parties and connected persons. Now, what are your related parties and connected persons? We'll go through in a minute. The UAE transfer pricing rules are quite top-notch. They are best international quality, which have been highly leveraged from the rules we have in the UK, published by HMRC, or in the Netherlands, or in India. And they are guided by the OECD transfer pricing guidelines in the latest version, which is the January 2022 version of the OECD transfer pricing guidelines. Now, in transfer pricing, we are quite fortunate that there is a lot of soft law guidance available in the OECD transfer pricing guidelines, because these guidelines runs into 800s of pages. It has 10 chapters, but it provides guidance as to what you need to do on a particular related party situation or scenario. So unlike corporate tax, where we have quite some uncertainties on certain positions which the UAE FTA would follow, but transfer pricing, we are a bit lucky and blessed in that instance that we have a lot of soft law guidance available from the OECD transfer pricing guidelines. And the FTA has fully endorsed the 2022 OECD transfer pricing guidelines into the law, and that has been explicitly mentioned in the corporate tax law, which was released back in time, but also the explanatory guide, which came in explaining and clarifying certain aspects of the corporate tax law. Now, who does transfer pricing applies to? It applies to all the UAE taxable persons having transactions with their related parties and connected persons. And similar to corporate income tax in the UAE, transfer pricing also applies for all financial years starting on or after 1st June 2023. Now, what we need to be careful of from a transfer pricing perspective is that the UAE transfer pricing law covers both international and domestic transactions. Now, what that means is that any transactions which are undertaken by the UAE entities with their overseas entities, they have to be looked into from a transfer pricing perspective, but also the transactions happening domestically within the UAE, they also need to be taken care of from a transfer pricing perspective. What that basically means is any transactions you are undertaking with your group entities internationally or domestically should be priced at a fair market value. Now, in technical transfer pricing terms, this is called the arm's length principle. And the arm's length principle basically means is that whatever pricing you apply to your third-party situations, similar pricing you should apply to your related party situations. Because the tax authorities are smart enough to understand that 60% of the world's international trade and services is between related parties, and they don't want to miss on their fair share of taxes when it comes to transactions between the group's related parties. In the UAE, there is a peculiar concept of connected persons, and that is there for a reason, that the UAE doesn't have personal income tax yet on the individuals. So the tax authorities want to make sure that you are not making excessive payments to your connected persons just to bring your corporate income tax liability down. So that is why the concept of connected persons has been brought into the UAE transfer pricing law. Now, this concept already exists in the Saudi transfer pricing law, and it has been picked up from there for similar situations, because in Saudi also there was the situation of no tax on persons and individuals like us. So this is quite a peculiar subject. It's a new subject, but we have done it in the past while dealing with the ZATCA, the Saudi tax authorities, and we know the nitty-gritties here. Now, in the UAE, there's a concept of a free zone person, which is eligible for a 0% tax holiday, subject to certain conditions being met. And one of the very key conditions is of transfer pricing. So if your transfer pricing is not at arm's length from a UAE perspective, you could be debarred of your 0% tax holiday for 5 years, starting from your current year and the next 4 years. So that is why whenever we are structuring tax and transfer pricing model, we have to be really sure that all the transactions which are undertaken by the free zone entities with their related parties, be it domestically or internationally, they should be at arm's length. Now, what happens if you prove that your transactions are at arm's length and you have a transfer pricing policy which is coming appropriately in your books of accounts? You need to maintain a set of transfer pricing documentation, and there are 4 levels of transfer pricing documentations in the UAE. One is a transfer pricing return, which would go with your corporate income tax return by 30th September 2025 for groups whose financial year starts from 1st January 24. The second is a master file, which needs to be maintained by the time of filing your corporate income tax return, and it has to be submitted within 30 days upon request by the FTA. The third one is a local file, which also has to be maintained by the time of filing your corporate tax return, but again has to be submitted within 30 days upon request by the FTA. And the last one is a country-by-country report, which has already been in place since 2018, when UAE committed to BEPS 2.0. So the transfer pricing is already in place. It's not a new regulation, but it forms part of one of the transfer pricing documentation requirements. So all in all, these are the transfer pricing requirements you need to take care of on a generic year-on-year basis. But the UAE transfer pricing law also has Article 61, which covers transitional TP rules, and what it essentially says is that your last year's transfer pricing before you go on to your first corporate tax year should be at arm's length, and the law specifically states that your closing balances, which would be your opening balances for the new year when your corporate tax kicks in for your organization, they should be at arm's length. Now, what that essentially means is that any transactions which are giving rise to your intercompany balances should essentially be at arm's length, which means that the tax authorities want you to apply transfer pricing principles in FY23 as well, before your corporate tax goes live. So if your financial year starts 1st January 24, and that is the first year of your corporate tax applicability, then you have to fix your transfer pricing for FY23 as well, is all what the transitional rules are trying to say. The last condition which I wanted to highlight is that if an entity has an exempt business, which is exempt from a corporate tax perspective, and a non-exempt business, then also the transfer pricing rules would apply to that entity, and the tax authorities would want to ensure that you're not shifting a lot of profits to an exempt business which are not eligible to pay taxes. So the scope of transfer pricing rules in the UAE is quite broad, and we have to be very careful when structuring your intercompany transactions and transfer pricing policies. Now, transfer pricing is not a compliance exercise just in itself. It's a tax efficiency tool as well, because if you properly structure your intercompany transactions, and if you properly make your transfer pricing model for covering all your intercompany transactions based on the roles and responsibilities of various parties in the group, you can achieve some tax efficiencies as well in a normal and a legal way. So just don't look at transfer pricing just as a tax compliance exercise or something you have to do in a regular course of business. Definitely that is the case, but it can help you achieve tax efficiencies as well if you plan it properly. Now, $1 million question always is, what are related parties and connected persons per se? First of all, I would like to break a myth here that related parties for audit purposes are not fully your related parties for tax purposes. They are a good starting point, but the UAE corporate tax law is quite particular on how you determine your related parties and connected persons. And that is based on the principle of management, control, and capital for determination of your related parties for tax and transfer pricing purposes. What that means is, capital is a straightforward thing which everyone can understand in the first instance, that if you own 50% or more shareholding in the other entity, you are a related party. Now, management is also easy to grasp. If common entities or common set of individuals, they are managing the other entities, taking key decisions on behalf of each other, then they are related parties for UAE corporate tax and transfer pricing purposes. The third condition is control, which is where it gets a bit tricky, and you need a specialist transfer pricing consultant to be looking at that. Because control is a gray area, and the way tax law defines the control provisions are that if a set of entities or individuals, they have the power to appoint more than 50% of the board of directors in a set of entities, they can control the voting rights, and they can significantly influence the business of the other entity, then in that condition, control could be exercised. And if one entity's profits are 50% or more dependent on the other entities, then those entities could be related party via a control principle. So this is where it gets very fishy, and we really need to have an eye for detail in determining control for related party purposes. Now we come to the principle of connected persons, and this is always an area of debate. And to be honest, as a transfer pricing advisor, this is the biggest struggle when we are looking into UAE businesses, of identifying connected persons first of all, because it's a brand new concept in the UAE, and we deal with a lot of family-owned businesses where this level of information is sometimes very personal, and people are possessive not to give this information. So we have to sit with the owners, shareholders, and the HR and look at their family book to identify which are the connected persons per se. A connected person is basically an owner, director, or officer of an organization and their relatives through fourth degree of kinship. And the way we define kinship is through marriage, birth, adoption, or guardianship. So the scope is quite vast. We really need to look into it very critically. First of all, to identify the connected persons, identify the payments made to the connected persons by reviewing the trial balances of the businesses, and identify the payments made to the relatives of the connected persons, and then come up to the thing that whether it's at arm's length or not. The explanatory guide explained what is a fourth degree of kinship and how far they can go. So they can even go to your greatest of grandparents who are not even on planet Earth. So that is the extent of limit the UAE tax authorities would like to cover with this provision, just because there is no personal income tax yet in the UAE, and they want to make sure that payments to connected persons are not excessive to bring down the profits on which tax would be applied. But still, even in the connected person definition, there are some gray areas which are as follows. The first one is, what is significant influence? So if we refer to IAS 28, it says significant influences taking key decisions on the operational and financial side of the business, or key decision is 20% or more ownership in the other business. That is one of the definition if we go to the accounting standards. Who are officers? Now, the law doesn't define officers yet. That is why it's a gray area. But our reasonable assumption is that all the key managerial personnel who are employed in the business are officers, and these could be CEO, CFO, COO, CTO, etc. But that is where we need to sit and decide with the management, who do you consider as the people who are really important to your business. The third and the last gray area is ownership interest. You see, if the first condition is a natural person who directly or indirectly owns an ownership interest in the other person. Now, what is ownership interest? Is it 5%, 10%, 50%? That is also a gray area which we need to fine tune, and we are awaiting further guidance from the law on these aspects. But at least these are, on the face of it, some gray areas wherein we are still looking for further guidance in the corporate tax law. But all in all, from a transfer pricing perspective, when you are identifying your related parties and connected persons, you have to look at these principles for correct and accurate identification of these entities and persons. Now, in terms of transfer pricing documentation requirements, there is a threshold published by the FTA, and that threshold basically says that if a UAE entity has a turnover exceeding 200 million dirhams in the relevant year, they have to maintain a master file and a local file. Or if they are part of the group whose consolidated turnover exceeds euro 750 million or AED 3.15 billion, then you have to maintain a master file and a local file. Now, these thresholds are just for master files and local files. Please note that there is no threshold yet for preparation of a transfer pricing disclosure form, a transfer pricing return which has to be filed. There could be one, but as we speak now, there is no threshold yet. And sometimes clients and taxpayers, UAE businesses, confuse themselves that if their revenue is less than this, they don't need to do a transfer pricing exercise. That is absolutely inaccurate. If your revenues are less than these, you still need to comply with the transfer pricing provisions based on Article 34 of the UAE Corporate Tax Law, which is the arm's length principle, but you don't have to maintain a master file and a local file if you don't breach this threshold. Now, there is a concept of tax grouping in the UAE Corporate Tax Law, and again, there is a myth that if we are in a tax group, we can simply excuse transfer pricing. Again, we have to be careful here. There are a set of certain conditions. We need to tick the boxes there, and if those conditions are met, then transfer pricing can be excused in a tax group. Now, these conditions are if any member of the tax group has pre-grouping losses, They have pre-grouping interest expenditure. They are availing a corporate tax benefit, like a free zone, or any other incentive which comes in, and they're availing a foreign tax credit. Now, if these are the four situations in a tax group availed by any member within the group, transfer pricing has to be complied with within a tax group as well. Or if there is an entity coming into a tax group with its set of losses, then in order to make sure that that entity is utilizing those respective losses brought into the tax group with its corresponding income, you need to maintain transfer pricing rules within the tax groups as well. All in all, what our advice is, it could be painful from an operational perspective in the first year to apply transfer pricing within a tax group, but still you should go ahead with that because it is required for best practices as we have seen in the foreign countries. Or if tomorrow you are spinning off a particular business from your group and you need to identify what is the share valuation of that spin-off, and if you have not applied transfer pricing within that business segment, you cannot get a fair share valuation for that business per se. And it is also helpful for the CFOs and CEOs if they are looking at their respective P&Ls within a tax group and they know that there are certain entities in the tax group who are having a lot of related party transactions, and if you haven't taken care of transfer pricing in a tax group, then the profitability of those entities having significant related party transactions wouldn't be accurate because you have never dealt with transfer pricing in a tax group. So on a best practices perspective, the recommendation is, since it's all very new starting from scratch, to equally apply transfer pricing in a tax group as well for tax efficiencies, best practices, and better financial and management reporting. Now, what does a master file, local file, CBCR, and a TP return contain? So a master file is a holistic overview of the group. It talks about the group's business, group's legal structure, management structure, the intercompany transactions undertaken by the group, how it is financially leveraged, what are the intangibles within the group, and who is doing what in a group, and where are various group entities. So a group master file enables the tax authorities to look at the group from 60,000 feet as to what happens within a group. Now, the second tier of transfer pricing documentation is a local file. Now, this is more relevant to your local UAE taxpayer, be it in a free zone or mainland. So if you have transactions between the UAE entities, then the UAE local file will explain those transactions, explain the legal and management structure of the local entity, what is the financial position of the local entity, and how you have determined that these transactions are at arm's length. Now, the third kind of documentation is a country-by-country report, which is only applicable for businesses whose consolidated turnover exceeds AED 3.15 billion. And this is a number crunching game in the CBCR because it gives information about the number of jurisdictions the group is, the capital, the revenues, related party, third party, profitability per entity and per country, and the number of employees. So the tax authorities are using CBCR as a risk assessment tool to see where are the transfer pricing red flags in your businesses, and they are making up their mind to audit you or not by reviewing this documentation. Last but not the least, transfer pricing disclosure form. Now, the format and the content for the disclosure form is not out yet, but as we have seen in Saudi Arabia and Qatar, this type of documentation has information on your related party transactions, ownership criteria, the amount of your related party transactions, and how you have priced these transactions from a transfer pricing perspective. So these are the 4 levels of transfer pricing documentations you need to maintain if you qualify certain thresholds. But to reiterate, there is no threshold yet for preparation of a transfer pricing disclosure form. Now, there is a lot of transfer pricing action going on in the Middle East, and UAE is following that. If you see the slide, Saudi Arabia has transfer pricing rules from 2018. Egypt had transfer pricing rules from 2005. And Qatar has transfer pricing rules from 2021, and now UAE has introduced it. Even Jordan introduced it in 2021. So there is a lot of action going in the transfer pricing domain. And me being a transfer pricing advisor here, I spend a lot of time also arguing on transfer pricing cases with the ZATCA, the Saudi tax authorities, and the QFC, the Qatari tax authorities, because they understand the subject pretty well. And they have been taking regular trainings with the IRS, with the advanced tax jurisdictions, tax authorities, to understand this subject. So transfer pricing is heavily picking up in the region, not only in the UAE. So we need to be careful when we are designing our tax and transfer pricing models, because transfer pricing is not a one-side story. We have to make sure that both countries and both entities on two sides of the world, they are getting their fair share of profits from a transfer pricing situation, because the tax authorities would be looking at their respective profitabilities when they are looking at their respective local taxpayers. So the idea of this slide was to make you understand that there is a lot of action going on in the Middle East on transfer pricing, and the tax authorities are smart enough to understand that this is a tax efficiency tool as well, so they don't want to miss on their fair share of taxes when it comes to related parties, connected persons, and transfer pricing situations. Now, here is a quick example to take you through what we go with transfer pricing when we are looking at UAE businesses. So 90% of the UAE businesses, they are family-owned businesses, UAE headquartered businesses with operations outside. And what we generally see in these kind of situations is that there is a UAE entity which is called a principal entity here, which is kind of a control tower, as I would say in simple terms. And what that essentially means is that it is employing all the key managerial personnel, all the C-suite, who are making strategic decisions for the group. How will the group grow in the next 5 years, controlling the key value drivers, determining the success factors, taking care of the intellectual properties, be it brand, trademark, trade name, patents, etc., technical know-how. They are taking key decisions on sales, what would be the sales strategy, key decisions on procurement, how would they be procuring the goods, key decisions on general management and support functions like HR, IT, finance, legal, etc. And they're also bearing some key risk, for example, market risk, the risk from competition, price risk, inventory risk, bad debt, credit risk. So we generally see that this principal operating company, which is a control tower sitting in the UAE, is the operational headquarter in the group. And then it has other entities on the right-hand side of the slides, which are an IP company, which is a manufacturing company, a sales company, and a service company. So all in all, transfer pricing is all about understanding your business and laying a transfer pricing model on top of your business. Now, we as tax and transfer pricing advisors don't tell you how you should do your business. The business is well aware how they need to grow in the market. We are laying a tax and transfer pricing model on top of your business operations. So if we see something of this sort, that there is a group entity which is really entrepreneurial, and then there are other companies which are routine entities, and they are working under the direction, supervision, management, and control of one entity, then how should profitability flow within this related party situation? And taking care also of the place of effective management rules from a corporate tax perspective. Now, if we think about the profitability, we look into 4 or 5 key things. First of all, when we look into profitability, we understand the business, what each of the entity is doing, which was there on the last slide. Then we categorize the decisions and the functions into several categories. The first category is strategic. Second category is tactical. Third category is routine. And the fourth and last category is a risk-free category. So strategic decisions are done by the control tower, which was on the last slide. So key decisions around sales, marketing, procurement, business strategy, general management, and support. These people deserve the highest level of profitability in a related party situation. Then comes the tactical decisions, which is more like executing the strategy which has been developed at the strategic level. So there are people like CEOs, CFOs, CTO who are executing the strategy which has been developed by the board of directors or the shareholders. Then comes the routine entities which are working under the strict supervision of the strategical and tactical people in an organization. So they deserve less profitability as compared to the strategic and tactical people in the business. And then comes a risk-free, for example, a legal owner of IP that doesn't deserve a lot of remuneration. So we have to always, when we are applying a transfer pricing hat on top of our business, we always need to think about the roles and responsibilities of group entities, who are the strategic, tactical, routine, and risk-free people in the business and the entities, and how we price them from a transfer pricing perspective. So all in all, this was what I wanted to discuss today. Just some key remarks. I'm done in time. Transfer pricing is like a fingerprint. It is very different to each organization, and it is fully dependent on the intercompany transactions which an organization is undertaking. There is no need to be scared. The UAE tax authorities are building a great tax and a transfer pricing team which is best in class. They're hiring people from the UK, France, and foreign jurisdictions who understand this subject pretty well. We are always here to help you. There's nothing to be scared. UAE tax authorities would be nowhere closer to how Indian, Chinese, or French tax authorities are. They're super aggressive. UAE is always about the ease of doing business, being tax friendly. And even the biggest example is, see the free zone guidance. The law came in, but there was a lot of feedback to the FTA because there were certain things which were missing. And the FTA was so nice to accept all the feedback, given a public consultation document, and now they are reviewing the comments. And trust you me, we as MMJS, we gave some comments to the free zone public consultation document, and we got a call from the FTA that, listen, we want to discuss 2 of your remarks and how many clients are impacted by this. So it's a great time to be here. Thank you all for listening in. Transfer pricing is an interesting subject, and hopefully you all like the session. Thank you.